Hi, I'm Trey Witt. I've been a CPA for many years, providing tax and financial consulting to dental practice owners. One trait that nearly all dentists, and all taxpayers for that matter, have in common is a dread of all things income tax. The rules don't make sense to most people, and they change every year, making costly foul ups inevitable. Recently, I put together a series of short presentations aimed at taking the mystery out of income taxes. These presentations won't make you a tax expert, but hopefully they will give you enough information to make the tax planning and tax paying processes more clear and hopefully less painful. This first presentation tackles tax planning. We will cover a very simple process for ballparking how much tax you will owe this next year. Let's get started. What exactly is tax planning? Tax planning is no different than planning for your staff expense, your lab fees, your dental supplies, your rents. You know you're going to have to pay something. You just want to know about how much it's going to be. And to the extent that we can contain that cost, we want to take reasonable measures to do so. Tax planning is just for the wealthy, right? Well, no. Remember, tax planning is just the process by which we figure out how much tax are we going to owe and how much do we have budgeted. And if during that process we can figure out some clever ways to lower our tax exposure, well then that's all the better. But that is not just simply the domain of the wealthy, it is the domain of all taxpayers. Tax planning is just something you do at the end of the year, right? Isn't that what we look at between Thanksgiving and Christmas to figure out that we've got everything just the way we want it? Well, yes, you can do that, but if you wait until November to do your tax planning, you've squandered most of the year, and there are plenty of opportunities, especially if you are a business owner, to do things that may require a little bit of lead time, but they can save you some money on the tax side of things. So what does that have to do with this picture here? Nothing much. This is a picture of me and my family at a Braves game in July, and absolutely you could do tax planning in July. All right, well, let me take just 30 seconds and talk about what tax planning does not have to be. Tax planning does not have to be an exercise where you gather mountains of data and you head over to the accountant's office. The accountant goes through all of the paperwork, opens up a spreadsheet, maybe opens up some tax planning software, and spends an hour or two doing math. That does not have to be what tax planning is. Tax planning should be easy enough to where you can do it over the phone or you can do it from anywhere. It should not require a whole lot of data, just some basics. And tax planning should be easy enough to where you can easily update it so that when you get close to the end of the year, you're pretty much on target. The objectives of tax planning are very easy. Peace of mind and avoiding the ugly tax surprise. If you spend enough time during the year taking a look at your tax situation, comparing it to the prior year, and identifying differences between this year and last year, you ought to come pretty close on the taxes. And that's really what we're trying to do. As I've mentioned several times, if during the process we're able to figure out ways for you to save money, well then absolutely we want to do that. But the more attention that you give it, the more likely that is to happen. So how do we get started with tax planning? Well, I start with last year's tax return. So if I prepared your tax return last year, I've got that. If I didn't prepare your tax return last year, I'm going to ask you for a copy of it. I'm also going to determine from that return what your last year's tax liability was. That's my starting point for figuring out how much you're going to owe this year. And then through a conversation, you and I are going to talk about what we expect to be the same this year. I've given you some examples: family, job, house, charity, other things. And then what do you expect to be different? Sometimes your investment income can be higher or lower. If you're a business owner, you certainly know that there is great volatility in the income that you can derive from your business. Really, what we're locked in on are not the things that are going to be the same as last year, but the things that are going to be different and potentially cause your tax liability to go up or to go down. So what I'm talking about when I say lock in on the differences is I want to know the difference between last year and this year. Is your income going to be higher? Is it going to be lower? And then I also want to know what kind of tax rate I ought to be applying to those differences. So really, the math there is, okay, I know how much your tax liability was last year. Well, does an increase in your income from last year, does a decrease in your income from last year, what sort of effect is that going to have on the overall tax picture? Once I know what your tax liability is going to be, or estimated to be, then we can compare that to the taxes that you are having withheld from your wages and or what you have budgeted or what you have already paid in quarterly tax payments. Okay, so I hate it when people try to talk math to me, so let me give you an example here, and you can follow along with the text as I'm narrating here. Taxpayer has gross income of $300,000 and itemized deductions of $30,000. So that's taxable income of $270,000, right? And let's say that her tax liability in the prior year on that taxable income was $60,000. Well, we can do the math and figure out what the average tax rate is. The numerator is $60,000, which was the tax liability, and the denominator was taxable income, which is gross income minus the itemized deduction. So if we do that math, we get an average tax rate of 22%. All right? Taxpayer tells us that she expects to have an increase in her wage income of $30,000, and she expects all other income and deductions to be the same. Okay, so we know that her tax bill last year was $60,000, and we know that her average tax rate was 22%, and we also know that she expects an increase in taxable income of $30,000. And so the math is in that fourth bullet point, last one on the bottom there, where we expect her tax to be $60,000, again, last year's tax, plus the increase in income times her average tax rate. So the increase in income of $30,000 times 22% average tax rate. So we expect her tax liability to be $67,000. All right, so to close the loop on the exercise, we would then go back to the taxpayer and say, okay, how much are you actually having withheld from your wages this year? And we can project that out. And let's say we did a mid-year look, and at the mid-year point, she had $20,000 withheld in tax. Well, that means that she has got to make up $47,000 worth of tax in the second half of the year. So that would be a bad situation. But we would be glad that we looked at it in the middle of the year so that she can make corrections to her withholding versus waiting until the end of the year where there is no recourse except for to write a big check at the end of the year when she files her return. So wrapping up this topic, is this method perfect for accurately projecting your taxes for the year? No, it's not a perfect method. We could have used your marginal tax rate instead of your average tax rate, but that would have added a little bit of complexity to the computation. And so I've opted for quick, easy, and reasonably accurate as a substitute for perfection. Perfection is not the goal when you're doing tax planning. Really, what you're trying to do is get your tax liability in a reasonable ballpark so that you can figure out whether your tax budgeting, both through your wage withholding and your quarterly tax payments, are sufficient to cover that tax liability. I also want it to be easy enough for you to perform multiple times during the year. You may do tax planning in the spring when your income is low, and then you may have a surge of income in the summer and the fall. And so I want you to be able to do a refresh to take into account variability in income throughout the year. As I say in that last bullet point, if you don't like your results or you're not confident in your math, please call your tax advisor. That's always good advice. He or she may have helpful tips on things that you can do to drive a better tax outcome than maybe you can on your own. Thank you for tuning in today. I hope you enjoyed this presentation. Please feel free to leave me some comments, some feedback on this presentation, suggestions on future presentations. I will be glad to see what I can do on that. I've given you my email address and my LinkedIn profile here. Again, thank you, and I hope you have a great day.